Hi everyone, I am Deric. Welcome to my channel. In this video, I'm going to talk about the importance of personal financial planning. First of all, what is personal financial planning? Personal financial planning is the process of managing your money in a way that helps you reach your financial goals. This includes creating a budget, saving money, investing, and planning for retirement. It also involves understanding and managing risks, such as not having enough money for emergencies or unexpected expenses. The goal is to make sure you have enough money for what you need now and in the future. Personal financial planning is important as it can help us manage the unplanned, accumulate wealth for special expenses, save for retirement, protect the assets, invest intelligently, and to minimize the tax payments. Now, let's talk about each point more. First, managing the unplanned. Personal financial planning helps you prepare for unexpected financial events. Some examples of unplanned financial events include job loss or reduction in income, illness or injury resulting in medical expenses, natural disasters or other emergencies that cause property damage, unexpected car or home repairs. To manage the unplanned, you would need an emergency fund, which is a savings account set aside specifically for unexpected expenses. The general rule of thumb is to save at least 3 to 6 months' worth of living expenses in this account. In this way, if an unplanned financial event occurs, you'll have the funds to cover expenses without going into debt or having to sell assets. Another way to manage the unplanned is to have insurance coverage for potential risks like health, home, car, etc. This will provide a safety net in case of unexpected events that could cause financial hardship. Second, accumulating wealth for special expenses. Personal financial planning can include strategies to accumulate wealth for special expenses, such as a child's education, a down payment on a house, or a luxurious vacation. After setting specific, measurable, and achievable goals, then you can develop a plan to reach those goals. For example, if your goal is to save for your child's college education, a personal financial plan would include estimating the cost of tuition, room and board, and other expenses, and then creating a savings plan to reach that goal. This may involve setting up a dedicated savings account, such as a college savings plan, and contributing a certain amount of money each month. Another example, if you want to accumulate wealth for a down payment on a house, you can set a goal for the amount you want to save, and create a budget that allocates money towards saving for a down payment. You may also consider increasing your income through a side job or starting a small business, or cutting unnecessary expenses. Third, saving for retirement. It involves creating a plan to ensure that you have enough money saved to cover your expenses during retirement. This can include estimating how much money you will need in retirement based on your expected living expenses and desired lifestyle, assessing your current savings and investments, and determining if you are on track to reach your retirement goals, creating a savings plan to increase your savings for retirement, investing your savings in a diversified portfolio of assets to grow your nest egg over time, considering different retirement saving options such as 401k or IRA, seeking professional advice if needed, reviewing your plan regularly and making adjustments as needed, such as increasing your savings rate or adjusting your investment mix. Fourth, protecting the assets. This is about purchasing insurance to protect against unexpected events such as accidents, illness, or death. For example, you would need health insurance to cover medical expenses, life insurance to provide for your loved ones in case of your death, and property insurance to protect your home and personal possessions. Another way to protect your assets is by creating a will or trust. This is to ensure that your assets are distributed according to your wishes after you pass away. This can also include creating a power of attorney, which allows someone else to make financial and legal decisions on your behalf, in case you become incapacitated. In short, this is to provide for your loved ones in case of unexpected events. That's why it's important to protect your assets and make sure you have the right insurance and legal documents in place. Fifth, investing intelligently. To invest intelligently, you must have a clear understanding of your financial goals and risk tolerance. This will help you determine which types of investments are suitable for you. An important aspect of investing is diversification. Diversification is the practice of spreading your investments across different asset classes, such as stocks, bonds, and real estate. This helps to reduce the overall risk of your portfolio. You should do your own research and not rely solely on the advice of others. You may research on different types of investments and understand the risks and potential returns associated with each type. Most importantly, invest for long-term and avoid short-term trading. Don't try to chase short-term gains or time the market. Instead, focus on building a well-diversified portfolio that aligns with your financial goals and risk tolerance, and then hold on to it for the long term. 6. Minimizing tax payments. You may learn some ways to minimize your tax payments. Maximize deductions and credits. Look into tax deductions and credits that you may be eligible for, such as deductions for charitable donations, mortgage interest, and state and local taxes. Contribute to a retirement account. Contributions to a 401k or traditional IRA can lower your taxable income and help you save for retirement. Invest in a health savings account, HSA. Contributions to an HSA are tax-deductible and can be used to pay for qualified medical expenses. Keep track of your business expenses. If you are self-employed or run a small business, make sure to keep detailed records of all business expenses. These expenses can be deducted from your taxable income. Consider a Roth IRA. Contributions to a Roth IRA are made with after-tax dollars and grow tax-free, so you won't have to pay taxes on the money when you withdraw it in retirement. Take advantage of capital gains tax rates. Capital gains tax rates are typically lower than ordinary income tax rates, so you may consider selling assets that have appreciated in value. Review your tax withholding. Make sure that your employer is withholding the correct amount of taxes from your paychecks. If you're having too much withheld, you could be missing out on money that could be invested or saved. Seek professional advice. A financial advisor or tax professional can help you identify additional tax-saving strategies specific to your situation. Next, let's look at the 10 steps in personal financial planning. Step 1. Assess your current financial situation. This includes evaluating your income, expenses, assets, and liabilities. Step 2. Set financial goals. Determine what you want to achieve financially in the short and long term, such as paying off debt, saving for retirement, or buying a home. Step 3. Develop a budget. Create a plan for managing your income and expenses to reach your financial goals. Step 4. Create a savings plan. Establish a plan for saving money, such as setting up automatic transfers to a savings account. Step 5. Invest for growth. Consider different investment options such as stocks, bonds, or real estate to grow your money over time. Step 6. Protect your assets. Purchase insurance to protect your assets and income in case of unexpected events. Step 7. Minimize taxes. Take advantage of tax deductions and credits to reduce your tax liability. Step 8. Review and adjust your plan. Regularly review your plan and make adjustments as necessary to ensure it is meeting your goals and needs. Step 9. Seek professional advice. Consult with a financial advisor or tax professional for guidance and advice. Step 10. Implement and monitor your plan. Take action on your plan and track your progress to ensure it is working effectively and making progress towards your goals.